Good day, everyone. Ali Safi here from Safi Financial Network, and here is the video 2025 market outlook. 2024 was marvelous for a stock market. It was wonderful move, more than 24%, because today we just dipped down another 1%, and 24% performance growth for 2024. What's going to be the outlook for 2025? So we're going to cover lots of charts, materials, educational materials as well. So stay tuned. You're going to be amused by this video. All right, so let's just start what we're going to cover today. We're going to go through Buffett indicator first, and that Buffett allocation and some Fred fundamental charts. Though lots of good materials are going to be covered as well, because I think based on the fundamental charts, based on some indicators, and based on some cycles, we can have a glimpse of the market in a bigger picture, not day by day, not weekly. Weekly, I'm going to cover it. Daily, I'm going to cover it in daily analysis video, as I just had it today and yesterday, and I'm going to have it tomorrow. But this is going to give us what's going to be the overall trend for 2025. All right. So KP ratio is going to be the next one. And we're going to go through 2024 overview for S&P 500 chart, NASDAQ, and Dow Jones. We're going to just have a look and see what 2024 can lead us for 2025. And we're going to cover long-term cycles, intermediate cycles, short-term cycles, and above all, I'm going to cover my forecast for 2025. All right, let's just start with this guy, Warren Buffett, my favorite one. I know it's going to be your favorite as well. So Buffett has indicator, which is Buffett indicator. And it's pretty simple. The US stock market value divided by GDP, gross domestic product. And total US stock market value is going to be 45 trillion. And US GDP is 22.5 trillion. If we divide these two, we're going to get to 200%. And 200% Buffett indicator is a lot. This ratio is a lot. Why? Because historically, Buffett suggested that 70% to 80% is going to be fantastic, favorable time for buy. Opportunity doesn't give us every single day. So it's going to happen potentially in market crashes, recessions, and those market bottoms, which can happen at the end of the cycles, right? So 2007, 2008, 2009 was one of them. COVID crashes hit. But the Buffett indicator didn't get to 78%, 70%, 80%, but that was a good indicator for the market bottom, because market just went down 35% for S&P 500. For those cyclical or periodic area, we can buy because the Buffett indicator is getting low. When Buffett indicator is getting high, this high, we're going to be cautious. And this is not good. In 2000, 2001, 2002, the Buffett indicator before dot-com bubble exceed 170%. And in Great Recession, 2007, 07, 08, and 09 was the bottom. So before the Great Recession, Buffett indicator was roughly around 125%. So this chart tells us exactly the Buffett allocation, cash allocation. So as you see, Buffett is kind of like early to the game. It doesn't mean that when he's cash out, or he has a substantial cash in his account, it means the recession is coming tomorrow. For example, in 2008 and 2009, if you see here, so Buffett just exceed the cash over 25% in 2004, but recession came up in 2008. And you see that the money deploy when recession came up, and Buffett just bought lots of stocks there. However, even at the bottom of the crash, he still keeps above like 6-7% cash allocation. This means he always have cash. He is not all in all the time. Sometimes he was pretty close to all in 94, 98, even 97. But right after that, he just bring up the cash pretty close to over like a 10%. So when he's above 10%, when he's getting to 15%, this means he is getting cautious. And right now he's 28%, more than 25% cash in his allocation, which is going to be historic high cash allocation. All right. So this is kind of like telling us potentially for the next few years, we're going to have a bumpy road. It's not going to be smooth. All right. Let's shift the gear to Fred charts. So the first one is industrial production. As you see here, production is going to dip down when there is a recession. So those gray columns are the recessionary period. It doesn't tell us we are heading to recession. It's pretty close to the top, but usually I would say since 2008, when we are getting to this level, this is going to stay here until the recession happens. So this is, for example, 2007, 2008. It was here above 100%. And here is 2015, 16, which we went into a choppy, kind of like a consolidation, multi-year choppy. If you remember, Europe debt crisis actually just happened in this area. And this is COVID crash, just dumped down. And that was a very, very short recession, probably the shortest recession in the history, and then getting back up. Right now, again, we are getting back over 100%. So this means when we are getting over 100, we should be careful. It doesn't mean that, again, recession is coming tomorrow, but this is kind of like a yellow, I should say, flag for us. It's not red, but it is yellow. We should be careful. This is telling me that we should be more than careful. Why? Because this is layoffs chart. And as you see here, again, in recession, it's going to jump up, spike up. This is a COVID crash. You see that how spiked up even like, I think this is one of the biggest in the history after Great Depression. But in 2008, 2009, it just went up nicely and then coming down. Right now, we are below 2000, which is pretty good. But the next chart is telling me that we should be careful, folks. So when job openings, position openings are slowing down, this means Federal Reserve had a fantastic job on suppressing the economy, slowing down the economy. All right. So whenever pressing the economy dumping, they're not slowing down the economy, they're dumping economy. They want to slow down. They want to have a soft landing, but ultimately they just smash the economy and they're just leading the economy into recession. In 2008, they just put interest rate at its high, job openings just getting down just because businesses are getting bankrupt, folks. Businesses cannot survive in high interest rate environment. And right now it's exactly the same scenario happening like 2008, 2020. Even 2020, before that, it was not because of the interest rate. But if you remember, Federal Reserve tries to increase the rate by 25 basis every single month until 2018. And then they just fix it at 2%, 225 for 2 years. And then COVID just hit and they bring the rate down to zero. Again, this is going to be the same scenario. So they're going to just increase the rate substantially after COVID just because they want to suppress the inflation. At the same time, they suppress the growth. They slow down the economy and they're heading into recession because job openings are down, market is slowing down. And when job openings are getting down, usually we are at the beginning of unemployment and layoffs are going to spike up. So the next chart is going to be unemployment. Unemployment during recession is going to spike up. It doesn't wait for us. We are getting into recession, then unemployment happening. Unemployment spike up. Then we notice that, oh, we are in recession. So this is the scenario. So job openings are down, economies are slowing down, and you see that unemployment start to ticking up. So when this one is spiking up, we are in recession. Not we are heading into recession, we are in recession. The next chart is interesting, interest rate. So this is the steepest growth rate in interest rate or interest rate hike since 1980. So we had the steepest one in 1980, but after that, Federal Reserve just going gradually. Even in 2008, when we hit into recession, we are just having like better consistent slope to the upside. But this is a steeper, guys. This is a steeper. And whenever we just are getting to the maximum limit, stays down, getting flat for 5-6 months, and then heading down. So right now we are heading down. So let's look at the different scenario before. When we are heading down, we are not getting into recession right away. Sometimes we did, sometimes even in recession, they just headed down. But sometimes before recession, they head down and they forced to just bring the rate down more because we are into recession 1990. Here is the 2000, just head down. And then a couple of months after we head into recession. In 2008, they just bring it down. And then we ended up to recession. In 2020, we just had a flat coming down, recession, boom. So we are kind of like at the pre-recessionary situation right now. Again, recession probably doesn't come in 2025, but we are very close, folks. The timing for recession is very hard, but we are very close. I would say we are closer than 2024. We are closer than 2023, 22. Obviously, we are very close. Potentially within the next 6 to 18 months, we are heading into recession. All right. So the next one is going to be Shiller KP ratio. So Shiller KP ratio, cyclically adjusted price to earnings, that is one of the best indicator that you can imagine. Some people are saying this is very, very old indicator. It worked for Dow Jones when Dow Jones flooded with lots of energy and financials. It doesn't work for NASDAQ. These days are leading the market, like big techies are leading the market. I would say no. It works every situation, but the conditions are different. But Shiller KP ratio is one of the best indicators that we can predict how economy is doing. Is it healthy or we are getting into trouble? So right now, I would say let's bring up some definitions for the high KP ratio, which means market overvaluation. Usually, if it goes above 30 to 35, we are historically above the market price. We are in overvaluation market situation. And sometimes when we're getting to that one, usually we are heading into recession or something like that. So when we're getting to 30 to 35, usually people needs to be cautious. Otherwise, they are just playing with the hot sand. The low KP ratio usually happens during market recession, market on undervaluation, right? So it's going to be like a below 10. But below 10 sometimes, I would say not sometimes, often is very, very hard to get below 10. Usually at 10, 15, I would buy. All right. So at 10, 15 level, I would buy. And that's going to be like an opportunity. Where are we now? So if you just look at this is the 10, 15, 20. So when we are getting above 25, everyone needs to be careful. For example, during a Great Depression, here is the scenario. We're just getting above 30, and then market just getting into Great Depression. And for many years, we were kind of like struggling. I would say we were struggling to get above even 15 to 20. Whenever we get to the 20, again, market just sold off sharply. So this means when we are getting to 30 and above, we should be careful for the few years. Even multi-decade bear market can happen. Why? Because we are overvalued, extremely overvalued for a long time, right? So the next scenario is going to be 2000. Look at that, how sharply it goes higher. 2000 is dot-com bubble. It's technology driven market, right? So it's just going all the way up to 48. And what happened exactly? We went into 13 years bear market. Yes, 13 years. Some people are calling for the bottom in 2002. In the next chart, I'm just telling you exactly what do I mean by 13 years bear market. So we are at 38.35. We're pretty close to the previous top here, which is concerning for me because the next bear market, if it comes, it's not gonna be over in a few years. Probably we are gonna stay for more than 10 years, which is gonna be multi-decade bear market. This is the chart for 2000, 2002, 2007. All right, so this is a monthly chart for S&P 500. Look at that. So if you bought at the top of the market at 2000, March 2000, what happened to your money? It went down all the way. October 2002, market just formed the bottom, then hiking up, double top here, October 2007. Look at the months, folks. March, October, March, October. We are heading to another March, by the way. So March 2000, October 2007, again, we hit the top here, going all the way down. A year and a half bear market going down. March 2009, March 2013, we broke up above those tops. So from year 2000, exactly March 2000 to March 2013, for 13 years, your money didn't go anywhere. This is the bear market that I'm talking. Bear market doesn't mean that you're going to go down year after year. You can be choppy, big, wide range consolidation over 5 years, over 6 years. In this case, over 13 years. Your money didn't go well, but if you accumulated here and here, you were in the money. We're just talking about the bear market in a consolidation phase, right? So the market index doesn't go anywhere. So this is the bear market that I'm talking about. right? So we are heading into multi-decade bear market. When we are close, probably not in 2025, but probably in 2025, we will hit the top. So stay tuned. We're going to go over to that one. We are getting to the fun time. 2024 overview. So market for S&P 500, we had modest 10.45% to the downside in August low. So this is the red arrow there. And as you see here, when market just going up with the higher lows, this means the momentum is pretty strong. So we may see, because the market is too strong in 2024, we may see some profit taking, especially in January, February, or even during the year, like a mid-year, we're going to see the market is getting to exuberance to the top. And that euphoria situation gives us some money getting out. People are just taking the profit. So 2024 was too far, too strong, too fast. The correction was very modest and shallow. Historically, when this happens, a year after is going to be slower pace growth, usually on average 10%, 15%. If you want, you can have a look 2019 and then 2020. Obviously, you saw that the correction came up more than 35%. So this year, I would say we are going to head to see a correction, a sharp correction, sharp decline twice, more than 20%. Less likely it's going to get more than 25%, but 10 to 25, 10 to 20%, that's going to be the number that I'm looking at. All right. So in 2025, you should anticipate decline 10 to 20%. And that's going to be potential buying opportunity. We will talk about that. How about NASDAQ? NASDAQ was healthier, I would say, because the correction in August was 16%. That's pretty good. 16% correction. That's pretty nice correction. Dow Jones, how about this? This is ugly because the correction was pretty modest, just 6.95%. So this means Dow is very strong. And usually when Dow is stronger than the other indexes, this means money is going to heavy value names. So this tells me that money is parking into heavy value names for dividends, for just safety. So based on that, historically, when we are not getting more than 10 to 20% correction a year, usually the next year is going to be 10% to 20% decline. All right, so this is another interesting table. Year of crash, based on who is in the admin. As you see here, most crashes happened during Republicans. The last one was a Republican president in admin, Donald Trump. Who is the president for the next 4 years? Another Republican, Donald Trump is coming again. So it doesn't mean that 2025 is going to be a recession or the beginning of the recession, but we should be careful about next 4 years. And I would say first 2 years, we're going to see a market top, multi-decade market top. So 2025, 2026, we should just see the last drip of juice for the market. How about the long-term cycle, folks? So if you just look at this chart, this is pretty interesting. 72-year cycle, so start from March 2009. And we are at year 16. So we don't care about this. 36-year cycle started 2009, 16 years. It's going to be due 2039, 2051. We are not going to pay attention on this. But the rest is pretty interesting. If you just see that 18-year cycle is 2009, 9-year cycle is 2020, and 6-year cycle is going to be 2022. So we are heading into pretty interesting situation just because for 18-year cycle, we are in a due time, 2024 until 2030. We are in 2025. We are due for this cycle. So we should see some kind of like a big correction is coming at least, or recession based on 18-year cycle. 9-year cycle is going to start 2027 until 2031. So I would say based on the long-term cycle, we are getting into choppy in 2025, 2026 with big swings to the up and down, but 2027 to 2030, that's going to be the recessionary period for the US stock market. So we are heading into a multi-decade recessionary period. This is the cycle that I have. And this, I believe we are here. We are pretty close to the market top at the green bar. So in 2025, we may see some kind of like a 6,500-ish. It can go higher to 7,000. It can even go higher to 8,000. I'm not predicting the price. I'm just saying about the cycle wise, we are seeing the top of the market potentially in 2025. But after that, we are getting close to the market top and we are heading to the decline, the multi-years decline all the way to 2029 to 2030. So this is the long-term cycle. How about intermediate cycles? So the outcome for 2025, a decline of 10% greater or steeper than October 2023 is very, very foreseeable scenario. So if you just look at 3-year cycle, 2-year cycle, and 50-week cycle, you'll understand that. So here is the 3-year cycle. You see that it starts at 2025. So the window that everyone needs to be careful is April 2025 to April 2026. All right, so it's coming. The next one is 2-year cycle, which is 2022 just started. And as you see here, June 2024, that's the window to February 2025. We had a good correction, however, in August. That was almost 10%. So if we say, hey, Ali, you're saying June 2024 and February 2025, potentially we are getting into, we just checked it. We checked it in August. So we don't need to have another one. I would accept that. Potentially, that's going to be the August. Otherwise, in January, February, we should see a sharp decline is coming. Okay, so that's going to be the sharp decline. And 50-week cycle is going to be March 31st to November 21st, 2025. So based on the 3-year cycle and 50-week cycle, I would say the period of April 2025 to November 2025, if you just have these two, so it's going to be the market bottom. All right. So again, April 2025 to November 2025, that's going to be probable time for market bottom. The short-term cycle is going to be this one. So this is a Jupiter-Neptune square. So we will get a significant decline window by June 2025 until August. So folks, just put it into ChatGPT, Jupiter, Neptune square, and based on the history, what happens to the market, to the stock market, and see what chat tells you. So historically, it's going to be a massive reversal. If market has peaked, it's going to reverse to the downside. If it's at the bottom, it's going to just jumping back up again. If market just going all the way up until April, March, I would say in June to August, we should have a sharp decline, a panic decline to the downside. 10 to 20% is coming. So unlikely it's going to go through 25%, but it's market is market, so you can't anticipate everything. But based on this, I would say April again, let's make it bigger. April 2025 to November 2025, that's going to be the bigger window. If you want to make it smaller, June 2025 to August 2025, that's the area everyone needs to be cautious if market is at the top. If market just going, let's say market start going lower from tomorrow all the way to June, I'm going to be buyer at June just because that's going to be a reversal, okay? Hope I make it clear to everyone that that's going to be the reversal, okay? So this is the first scenario that they have, and that's going to be market just going up in January and February. March hits its top and then getting back to the downside. And when we are getting to the June to August period, we are going to see the market bottom. And after that, market is going to just go back again to new all-time high potentially. But that's going to be the cycle top, and that's going to be the cycle low. All right, so that's the first scenario that I have. The second scenario is going to be shifted to the worst one, and that is the worst one. So we can see market is just going down all the way to March. We're going to have the corrective rally in March to April, and then getting back to the downside all the way to August, which is going to be 20% to the downside, potentially getting close to 5,000. 5,200. And after that, market just reversed into the backup, sharp rally all the way up to new all-time high. Remember, Donald Trump wants to see this happens. So again, another scenario, if market just doing very sideways consolidation or sharp decline, a wacky up, a wacky down, don't be surprised. So these are my forecasts for 2025, folks. Please put your comments down there. What do you think? What do you think about this? And how would you position yourself within this downtick and uptick in 2025? You can reach me here, Technical Analysis with Ali in YouTube. In Telegram, you can reach me, Safi Financial Network, Instagram as well, Safi Financial Network. You can reach me out there. And above all, thank you. Thank you, folks. Happy New Year, folks. Hope 2025 would be a fantastic year for you. It's going to be a tough year, but it's going to be a fantastic.